Hey everybody, this is Syme, your crypto CPA from the Lone Star State here at Akif CPA and also at Chainblock Financial. Today's video, we're going to go right into the heart of liquidity pools. What are liquidity pools? I know a lot of you guys are engaging in liquidity pools. There are some easy liquidity pools and there are some very difficult liquidity pools where you're putting a pair in and you're getting a completely different token back. So let's dissect today what liquidity pools are all about and how to do the accounting on liquidity pools properly so that you can make sure that you're not overpaying taxes when it comes to income recognition of liquidity pools and also the capital gain recognition on liquidity pools. And again, there are other practitioners out there that have a different view on it. Obviously, there's a conservative method, and I'll get to that as well too. And let's get right into it and let's take a deep dive. Come on. So scenario number one, you're putting one type of crypto into a liquidity pool. And what is a liquidity pool? Basically, essentially, you're lending your crypto. You're lending your crypto to a place, and they're calling this a liquidity pool where you're providing liquidity for something else. And in return for lending your crypto, you're getting rewards back. And typically, you will get your initial principal back as well too. But they want you to invest into this liquidity pool for a passage of time, right? They don't want you going in and out. And I understand that that's exactly just like that you see with CDs in a bank or any kind of depository institution where you can lock in your cash and you will get, 4%, 3%, 4% over a period of time. So in a very simplistic scenario of a liquidity pool, you're putting one crypto in, right? And then basically a passage of time is happening where it could be 6 months, 3 months, 1 month, whatever the case might be. And after that, you're getting a crypto back. Typically, it's always the same crypto if it's a very simple liquidity pool that you're investing in, kind of like staking, right? This is where the most basic form of staking is also happening. Putting one crypto in, time passes, and let's say you had invested one Ethereum, right? I'm gonna go ahead and put one Ethereum, and then you got back, let's say 1.5. So when you get that 1.5 back, a lot of times it will just be a bulk quantity that's going to come out of that liquidity pool. So what you need to do is that entire 1.5 is not your income. Most crypto accounting softwares out there, they're not going to let you parse this into two separate transactions where you're getting the one ETH that was your original investment back, and then the zero point 0.5 would be your earned income at that time, the minute it hits your wallet. And per the IRS's rules of dominion and control, which was established in 2014-21 notice, it needs to come into your wallet for you to recognize the income. So typical accounting when you're going in, some of these, and I'm just gonna use some very regular terms here. For example, CoinLeak, CoinTracking.info, or crypto tax calculator, and all of these have the very similar kind of verbiage. It would be in pool or liquidity in, going in, and then what you have is a liquidity out or out pool. So this is for your original investment, the one Ethereum. And I want to make this clear. This is one Ethereum, right? And the same one Ethereum is coming right back out. The 0.5 then, I'm going to put the 0.5 here, it's going to be income. Whether you call it other income, staking income, rewards, they're all treated the same way in the eyes of the IRS. They're all considered as earned income the minute you received it. And I believe it's the IRC code, the very old one, 61, that is earned income. Just imagine you didn't have this 0.5 Ethereum before, now you have it. So if you have it, you're going to consider that as earned income. So this would be and again, in a perfect world, when I'm lending somebody my crypto, the period that I purchased that crypto at, the date of the crypto, and also my cost basis. That is what I'm getting back, exactly what I put into the pool. A lot of crypto tax softwares will not do this properly, but again, this will not impact most of you out there unless the transactions are huge. But just remember, whatever you're putting into the pool, it's the exact same thing that's coming out of the pool plus the reward. So there should be no taxes on your original investment going in, and then your original investment coming out, and then there will be taxes at a taxable event that will happen on the zero point 0.5 Ethereum that you received. This is a very basic scenario of what a liquidity pool does. Very, very similar to staking rewards. And again, disclaimer, you can have a completely different scenario, and I will actually go through 4 different scenarios in this video, and I will show you how this can get complicated. So now let's get to, and remember, the accounting for it, how you classify this in your crypto tax software is the key in making sure everything is done properly. So now let's go to scenario number 2. In scenario number 2, let's say we put a crypto token into a pool, and as soon as we put our crypto token into a pool, what we get is an LP token back. This is considered as this LP token. And I just found a Uniswap icon online, and it could be a completely different uni this, uni that, and there's a million types of tokens. But basically, it's a placeholder. It's actually showing you instead of this one institution that is recording all your investments on their books. This is a way of recording your investment onto the blockchain. Also, is by giving you a token back, which typically is not tradable. So when you get that token back, you're holding on to it for a passage of time, right? And then you will return that token back to the liquidity pool, and then you will get that bulk initial investment plus your rewards. This is basically giving you ownership of your stake in this one particular pool, because pools can get really creative. And again, blockchain is a network for the people, by the people. So you're going to have creativity all over the place. But accounting for these transactions is paramount. Otherwise, you're going to end up overpaying or underpaying taxes. And then you're opening yourself up to huge sums of penalties. And guess what? And the IRS is watching these transactions like a hawk these days. So accounting for this would be, as soon as you went into a pool, this would be, going in similar to what I showed you on scenario 1, in pool, liquidity in. I'm going to go ahead and copy these, right? And then that token that you receive back, it's in a lot of accounting softwares, it will merge and it will have this as one set of transactions where you're putting a token into a pool. Simultaneously, you're getting something back, and then you're paying fees. So those 3 different transactions will be all considered as liquidity in. And depending on which crypto tax software you're using, there are options where if you want to take the conservative route, you can just have the initial piece, as soon as you go in as a taxable event, it will liquidate your crypto. But in reality, that's not what's happening, right? That is not what's happening. You're just putting a token into a pool. You're getting an LP token out of that pool, and basically that's a placeholder for you to have that ownership in that particular pool. So, but if you want to take the conservative route and have a taxable transaction, sure, why not? Unless if the price is going up, you're gonna have a gain right there and then. You're gonna have a massive gain on your original investment. So when you get this token back out after with that passage of time, and you've returned the LP token back into the pool, you get that big bulk crypto back. And that would be, if you can parse it, I would basically duplicate this transaction, and I would, instead of getting, let's say, I'm going to use the same figures, 1 ETH, and you're getting back 1.5 ETH. The out pool should be the 1 ETH, or liquidity out, and then the 0.5 would be your income. because that point 0.5 income is that taxable event. But in the case where you took the conservative route, you had a taxable event right from the get-go. When you went into the pool, you will have a taxable transaction there. And then when you're coming out of the pool, because then it will say that you exchange one ETH for this one LP token, and you liquidated it. So if you purchase this ETH at 500 bucks, hypothetical, and now it's worth 3,000 bucks. When you purchase this LP token, you purchased it for 3,000 bucks. So you'll have that 2,500 as a capital gain. And then with the passage of time, when you return this LP token back in the conservative scenario, depending on where the ETH is trading, you'll get that additional, because now you will have the full ETH, the 3,000 bucks here booked in. So you're starting here, and now if this is worth, let's say, 4,000, you'll have $1,000 of capital gain. But we know very well that this is your original investment going in, then you're getting your principal back, and then you have additional rewards. But you can take the conservative measure and conservative approach, but again, it will give you different results. But for accounting purposes, it can be super easy if you were to go this route. Now let's go to scenario number 3. Scenario number 3 is where you're putting 2 tokens into a pool, right? So you will have pool in or liquidity in. Some places you can also use the term staking deposit. That can also work. Again, you have to see for each and every single crypto party or third-party crypto tax software what their terminology is. Because I'll be honest with you, crypto tax calculator is based out of New Zealand, and yet they are the chosen ones for Coinbase, right? So even though they might have perfected their lingo and verbiage, but again, some of those rules are, I mean, look at where the software is starting. So you really need to understand, and no two softwares are alike. No two third-party crypto tax softwares are alike. So make sure you always read and see what's going on when you pick a classification method of your transactions. So now with this scenario number 3, let's say that you put 2 tokens into a pool, and with the passage of time it happens, and then you go in and there could be a dashboard, right, where you've invested, and then it's recorded on one of the transactions, and then with the passage of time you only get 1 token back. Now this is a unique one, and this happens now all the time. So now this liquidity pool has forced you to have a taxable event with the conversion. So typically, even though you know that they're going to be giving you 1 token back, basically you can't just, as soon as you're going into the pool, you're liquidating your investment. That's not how it should work. The way it works is you go in, there should be no taxable event. When you're coming out, there's 2 taxable events. One is a forceful conversion of this particular Solana token. Remember, let's just say 1 ETH went in and 1 Solana went in, right? And now you're getting, let's say, 2.5 ETH back. And the 0.5 is your reward, but the 2, so the 1 ETH that you received here, you're going to take out your 1 ETH back as your principal investment pool, and then there's a conversion of 1 Solana to 1 ETH, and then you have income of 0.5 ETH. So literally there's some manual work that needs to be done. And now in most cases, most liquidity pools that are giving you higher rewards, they're doing this where you're putting a pair in and you're getting something completely different back. So in this case, even though you got one of the original tokens back, you saved yourself in having, basically you only have 2 different taxable events. One is your conversion of this Solana to ETH, and then one is your income that you earned by investing into the liquidity pool. So you're basically converting. So when you get this back, you're doing this conversion. So you're doing this manually, actually. So a lot of times what I would do is, and because you want the timestamp to be the same, because when you're receiving back, duplicate those transactions and then edit them, and then make sure that they're flowing properly. Otherwise, it's going to give you a very skewed balance. It's going to give you a very skewed taxable event and taxable gain or loss. So make sure that is done properly. So, and again, scenarios, different crypto tax softwares are all unique. So make sure you're reading what the glossary of these third-party crypto tax tools, please. Now let's go to scenario number 4. Now imagine in this one, you're putting in a pair of token, they're going in, and again, we can get very fancy with scenarios. And then maybe you're getting an LP token out, and then you're returning that LP token, and then you're getting a completely different token. So this is something you'll see now. I've seen a lot of clients that are on Pulse Chain. This is happening to them a lot. But what's happening is they don't know how to convert this to this. So instead, they're marking this entire thing as income, and then they're overpaying their taxes by thousands, if not hundreds of thousands. And we've done this exercise so many times where you have to go in and manually fix this. So at the time of you making this investment, there should be no taxable event unless you're taking a conservative approach where you're saying, hey, if I send it to the liquidity pool, I don't know if this pool is a survivable pool. So I'm just going to send my investment, liquidate it, and whatever I get back is what I get back. And then you're basically just the portion that you got additional is your income. It's hard to basically keep track of all these things. So accounting for something like this would be what? Same thing as going in. Again, this is one of the methods. You might have a guru CPA that is well versed in crypto in your state who's doing it in a completely different way, but then maybe we're all getting to the same tax liability. Again, so now putting these tokens in, pool in, liquidity in, so there's no taxable event. You're retaining the actual characteristics of the crypto, Ethereum and Solana, both of them. These are just examples. And when it's time for you to get this out, now imagine there's 4 different. So first you have the Ethereum conversion of principal to TitanX. Then you have the Solana conversion of principal to TitanX. Then you have the additional TitanX received as income. So you need to factor for all 3 of these because they have now forcefully converted this crypto for you. And until you have dominion and control. Why do I keep repeating the words dominion and control? Because that means that now this is in your wallet, not in a dashboard somewhere, not in the crypto DeFi la la land. This is actually in your particular wallet. Now you have possession of it. And that is per the IRS and Department of Treasury's rules. Dominion and control. This is your friend. You need to know this, even for staking rewards. So now you have 3 different transactions that you're doing. So make sure you're doing all of these properly. Again, I could do a scenario 5, 6, 7, but as long as you know what's going on onto the underlying transactions and what happened and when this was converted and when this showed up back into your wallet, you need to account for all these things properly at that time, not in the middle somewhere where now on the dashboard it's showing you on their website or Uniswap or all these other places website is showing you now they've done a migration or this and that. They can do all what they want unless you get full control of it back. That's when you record the loss, the gain, the income, and all of that. So I hope I've made this a little bit clear. This is a topic that a lot of crypto tax tools, third-party tools, they're not going to get this right. This is because there's a lot of manual fixings that need to be done. So if you have further questions and if you want me to go ahead and cover another scenario, I'll be more than happy to do that. So drop us a like, subscribe, give us a comment below, get a front row seat to all of our future streams. If you want me to go ahead and do a live stream on a particular topic, please go ahead and email us. If you need any help with any of these liquidity pools, email us and we'll help you out. Thank you so much. This is Saim, your crypto CPA from the Lone Star State here at Akif CPA and also at Chainblock Financial. And what do? We make crypto taxes easy and less stressful so you can spend more time enjoying life, however that might be. So take care and have a good one.